$7.6 billion disappeared from America's energy pipeline. 321 federal awards were wiped out. 223 projects were caught in the blast. Battery plants, grid upgrades, hydrogen technology, carbon capture, projects designed to shape America's industrial future. Then the map appeared. 16 states. Every one of them backed Kamala Harris in 2024. The public explanation was simple. The Department of Energy said the projects were poor investments. They did not meet the country's energy needs. They did not offer taxpayers a positive return. Then a court filing revealed the part nobody was supposed to be debating. For one major cancellation tranche, the government acknowledged that projects were selected based solely on the political identity of the state where the recipient was located. That single sentence turned a budget cut into something much larger, because a government can cancel a weak project. It can cut waste. It can change an energy strategy. Those are normal acts of power. But when the political map becomes part of the screen, every factory, lender, utility, and investor sees a different risk. Not, can this project work? Will this project survive the next election? This is not just a fight about clean energy. It is a fight over whether a federal award is a dependable commitment, whether private capital can trust Washington, and whether America can build projects that take 5 years in a political system that resets every 4. This is the Mercer Ledger. And this is the real story behind the $7.6 billion cancellation. Start with what was actually cancelled. The number sounds simple. $7.6 billion vanished. But public funding is rarely a suitcase full of cash waiting at a factory gate. A federal award can be a grant, a cooperative agreement, a cost-sharing commitment, or a staged funding arrangement. It may cover design work, engineering, equipment, site preparation, testing, construction, or a later phase of a project. Some awards are fully spent. Some are partially obligated. Some have barely started. Some were announced but still needed permits, financing, local approvals, supply contracts, or technical milestones before reaching full construction. That distinction matters. Cancelling an award does not always mean a completed factory closes tomorrow, but it can mean that a factory never opens, a transmission upgrade does not move from plans to steel in the ground, or private investors decide that the risk is no longer worth taking. The Department of Energy's October announcement described the action as the termination of 321 awards supporting 223 projects. The department put the savings at roughly $7.56 billion. Its message was direct. Projects had been examined one by one. The agency said they did not advance national energy needs, were not economically viable, or did not provide a positive return on taxpayer investment. The department also emphasized timing. More than a quarter of the awards, worth more than $3 billion, had been made after the 2024 election and before the next administration took office. That detail became part of the political case for cancellation. To supporters of the cuts, it suggested a rush to lock in priorities before power changed hands. From that perspective, a review was not only reasonable, it was overdue. Why should a new administration be forced to continue expensive programs that it believes are inefficient, misdirected, or built around the wrong energy strategy? That is a serious argument. Federal agencies are not supposed to keep spending forever. Merely because a previous administration favored a program, governments change. Voters change governments. Policy priorities change with them. But the other side of the argument is just as important. Businesses do not build a battery line, a hydrogen plant, or a new power connection in a single election cycle. They sign equipment orders. They hire engineers. They negotiate with utilities. They arrange financing. They make commitments years before revenue arrives. And every one of those decisions depends on a simple assumption. If the federal government announces an award, signs an agreement, and tells the market a project is part of a national industrial strategy, that signal should mean something. This is why the court filing became so explosive. The issue was no longer merely whether the projects were good investments. The filing acknowledged that a cancellation group had been selected on the basis of the political identity of the state where the recipient was located. The states named in reporting on the filing included California, Colorado, Connecticut, Delaware, Hawaii, Illinois, Maryland, Massachusetts, Minnesota, New Hampshire, New Jersey, New Mexico, New York, Oregon, Vermont, and Washington. These are not identical economies. California is a giant technology, manufacturing, and energy market. Illinois has major industrial capacity and nuclear generation. Washington is tied to aerospace, hydropower, ports, and technology. New Mexico has an energy economy that includes oil, gas, national laboratories, and renewable development. Massachusetts and New York are major research and finance centers. What they had in common was not one industry. It was the 2024 electoral map. That changes how investors read the news. An investor can survive a strict review process. In fact, disciplined review is usually healthy. Projects should be tested for cost, technical feasibility, demand, execution risk, and public value. Weak projects should not be protected just because they carry a fashionable label. But a political selection rule is different. If investors believe that the location of an asset can become a deciding factor after an award has already been made, they do not simply reassess one program. They reassess the reliability of the entire policy environment. And reliability is an economic asset. Think about the financing stack. Behind a large industrial project, there may be federal support at the bottom, then state incentives, then local permits and infrastructure commitments, then bank debt, then equity from private investors, then long-term supply agreements, then customers willing to sign contracts for future output. The federal award may be only one layer of that stack, but it can be the layer that makes the others possible. Take it away, and the effect is not always equal to the amount of the grant. It can be much larger. A company that loses $10 million in expected public support may delay a project worth $200 million. A utility that loses backing for a grid upgrade may postpone work that would have enabled factories, data centers, housing, or new generation. A startup that loses a demonstration award may lose the credibility it needed to raise its next private round. That is why the $7.6 billion figure matters, even if not every dollar had been spent. The government's accounting question is straightforward. How much taxpayer money is no longer committed? The market's question is different. How much private investment, construction activity, manufacturing capacity, and long-term confidence disappears with that commitment? Those answers can be very far apart. Now look at the sectors involved. Battery manufacturing is not simply about electric cars. Batteries support storage for the power grid, backup systems, defense applications, industrial equipment, and a supply chain that many countries now consider strategically important. Grid upgrades are not glamorous, but they may be the most important part of the whole story. America can announce new factories, new data centers, new power plants, and new technologies. None of them work at scale if the grid cannot connect them, move the electricity, and maintain reliability. Hydrogen projects have their own risks. The technology is expensive, demand can be uncertain, and economics vary enormously by location and use case. Some projects may genuinely fail a cost-benefit test. Carbon capture is equally controversial. Supporters see it as a tool for industries that are difficult to decarbonize. Critics see it as costly and uncertain. But whether a project is loved or disliked is not the central issue here. The central issue is whether the government can tell markets that it is conducting an economic review, while court documents describe a political filter for selecting projects. Those are not the same thing. The distinction is crucial because a government can make a defensible case for either approach only if it is honest about which one it is using. If the goal is fiscal discipline, show the numbers. Show why each project fails. Show the projected cost, the expected benefit, the alternatives, the milestones missed, and the return that did not materialize. If the goal is a different energy strategy, say that openly. Say that the country is moving away from certain technologies and toward others. Markets may disagree, but they can at least adapt. But if political geography becomes the hidden screen, the decision stops looking like an investment review and starts looking like a map-based redistribution of federal power. That is where the legal battle enters. Several organizations and recipients challenged the cancellations. A federal judge in a separate grants dispute recently ruled that an administration could not simply terminate funding because grants no longer aligned with a president's priorities. That ruling does not automatically decide this specific case. Different programs, contracts, regulations, and claims can produce different outcomes. Still, the broader direction is clear. The courts are being asked to decide how much discretion the executive branch has after Congress has funded programs and agencies have issued awards. This is not a technical argument. It goes to the heart of how America finances long-term projects. Congress controls appropriations. Agencies administer programs. Presidents direct policy. Courts police the boundaries. Investors watch all three. And when those institutions send conflicting signals, capital becomes more cautious. That caution has a price. Not necessarily a dramatic crash, not a headline that appears on a market ticker. More often, it shows up quietly. An investment committee asks for another risk premium. A lender requires more collateral. A manufacturer waits 6 more months before ordering equipment. A foreign supplier decides to build capacity in another country. A startup moves its pilot project to a state or region where the funding rules look more predictable. Every one of these decisions can be rational on its own. Together, they can slow an industrial strategy without anyone ever formally cancelling it. This is the part politicians often underestimate. The real economic damage from uncertainty is not always the funding that gets pulled. It is the funding that never arrives because people decide not to take the first risk. For decades, the United States has asked private capital to help solve public problems, build more infrastructure, modernize factories, develop strategic technologies, reduce supply chain dependence, expand energy capacity, compete with China, secure domestic production. But private capital does not move on speeches alone. It moves on expected returns, enforceable agreements, stable rules, and a reasonable belief that a project will not be reclassified after money has already been committed. That does not mean every federal promise must be permanent. No sensible system should lock taxpayers into failed projects forever. Governments need the power to audit, pause, renegotiate, and terminate agreements when recipients miss milestones, misuse funds, or cannot prove value. The problem is that a credible review process must look credible from the outside. If the public sees a list of projects cancelled in states associated with one political coalition, and then sees a court filing that acknowledges political identity as the selection basis, the burden of proof becomes much higher. The government must show that its economic explanation is more than a label attached after the decision. And that brings us back to the Department of Energy's own case. Its argument is not impossible. Some energy awards may have been rushed. Some may have depended on unrealistic demand forecasts. Some may have been too expensive. Some may have been awarded late in the previous administration with weak protections for taxpayers. That can all be true. But it does not answer the question raised by the filing. If projects were selected because they were located in politically disfavored states, then the review process was not purely about project quality. It was also about political location. And once that principle enters the system, it becomes difficult to contain. Today the issue is clean energy funding in 16 states. Tomorrow it could be semiconductor incentives, transportation grants, research money, disaster recovery, defense contracts, or health programs. Every governor, mayor, utility executive, and corporate board will ask the same question. Does a federal commitment belong to the country as a whole, or does it belong to whichever political map controls Washington at the moment? There is another reason this story matters now. America is trying to build more electricity capacity at the same time that demand from data centers, advanced manufacturing, electrification, and population growth is putting pressure on the system. The country needs more generation, more transmission, more equipment, and faster construction. The exact mix of technologies is debatable. Nuclear, natural gas, renewables, storage, geothermal, carbon capture, and grid expansion all have supporters and critics. There is no serious energy strategy that avoids hard choices. But long construction timelines make policy instability especially expensive. A software company can change direction in a quarter. An energy project may need a decade. A grid line can take years of permitting before the first major construction contract is signed. A factory can require specialized equipment with long delivery times. A demonstration project can take years before anyone knows whether it works commercially. That means the United States does not only compete on technology, it competes on consistency. China can subsidize strategically. Europe can regulate and finance through long planning cycles. Gulf states can deploy state capital quickly. America's advantage has traditionally been its ability to combine public institutions with deep private markets. That advantage weakens if policy commitments become impossible to price. And this is why the cancellation story is bigger than a partisan dispute over green spending. It is a test of the American investment model. Can the country change policy without turning every prior commitment into a political hostage? Can it protect taxpayers without making long-term contracts worthless? Can it reject weak projects while still convincing the private sector that good projects will be treated fairly? The answer matters Because the federal government is not merely spending money. It is setting the rules that determine where trillions of dollars in private capital will go next. There is a practical way to see this risk. Imagine two companies planning similar energy projects. Both have comparable technology. Both have customers. Both need years of construction and large amounts of outside capital. One is in a market where funding rules are clear, reviews are published, and cancellations follow measurable milestones. The other is in a market where an award can be reopened after an election and where location may become part of the screen. The second company does not need to be certain that it will lose its funding. It only needs to believe that the possibility is large enough to change the math. It may demand a larger federal contribution before proceeding. Its lender may charge more. Its board may choose a smaller first phase. Or it may build somewhere else. That is how uncertainty becomes expensive without appearing as a line item in the federal budget. It is also why transparency is not a cosmetic issue. A government can cut a program and still preserve confidence if it gives investors a clear, repeatable standard. It can say, here are the milestones, here are the missed targets, here is the legal authority, and here is the appeal process. The more precise that explanation is, the easier it is for the market to separate a disciplined correction from a political reversal. Without that clarity, every future announcement becomes less valuable on the day it is made. For now, the facts are uncomfortable for everyone. The Department of Energy says it cut projects that failed to meet economic and energy criteria. Court documents acknowledged that political identity of the state was used as the selection basis for a group of cancellations. The recipients are fighting back. The courts have not finished speaking, and investors are left with a new calculation. Not just will this project work? Not just will customers buy the product? Not just can we build it on time and on budget? But also, will a change in Washington make the original agreement disappear? That is a risk premium no factory wants to pay. $7.6 billion is the headline number, but the number that really matters will never appear on a government balance sheet. It is the cost of trust. If a project is weak, cancel it. Publish the economics. Show the missed milestones. Show taxpayers exactly why the money should not go out the door. But if America wants factories, power lines, strategic supply chains, and private capital to move at speed, it has to make one thing clear. The rules cannot depend on who won a state 4 years earlier. That is the danger here. Not a disagreement over batteries. Not an argument over hydrogen. Not even a fight over $7.6 billion. The danger is a system where nobody knows whether the next decision will be made by an engineer, an accountant, a lawyer, or an electoral map. And once capital cannot tell the difference, it does what capital always does. It waits. Projects wait. Factories wait. Jobs wait. Private money waits. America did not just cancel grants. It sent a signal to every company trying to build the next generation of energy infrastructure. The question is whether that signal makes America stronger or simply makes the next investment easier to build somewhere else. That is the signal behind the money. This is the Mercer Ledger. Follow the money. Understand the power.